Good morning and welcome to this special Moneycontrol live stream session. Now the GDP growth for the December quarter came in at 8.4%. The numbers were released last evening, while the gross value added or GVA came in at 6.5%. And to discuss the numbers in a bit more details, we have now got with us Upasana Chachra, who is the Chief Economist, India Economist at Morgan Stanley. Upasana, welcome to the show and good to have you here.
Thank you. My pleasure.
So, Upasana, first up, big discrepancy between the GDP and the GVA reading. While the GDP number has been way ahead of what the market was expecting, the GVA appears to be trailing. So, what exactly explains this discrepancy?
Yes, sure. So GDP numbers released yesterday, with a growth of 8.4% for December quarter, were way ahead of our consensus expectations, which were somewhere around 6.5, 6.6%. While GVA growth came in more in line with expectations at 6.5%. There's a wedge between now the GDP and the GVA data, and to explain that, we have to see, what constitutes the difference between GDP and GVA. So when we look at GDP data, that's basically a measure of demand side of the economy, where we look at the aggregation of consumption expenditure across government or private final consumption expenditure, capex, that's all investments and spending by public, private, household segments, and also the net exports, so export and import growth. All of this culminates as the GDP or the demand side of the economy. While the GVA is more like a supply side measure of the economy or the value added, wherein we look at the value added by different sectors such as agri, industry, manufacturing and services. Now, to get to GDP, we add something called net indirect taxes, because GDP is a measure at purchaser price levels. So it should include the impact of government's taxes and subsidies. And this is the key reason for the wedge this time between GDP and GVA. So when we add net indirect taxes to the GVA measure, we get the GDP. And in this quarter, the net indirect taxes rose by upwards of 30% YOY. We can see some of it from the monthly data, i.e. indirect tax collections like GST tax collections were pretty robust. At the same time, the government subsidy spending declined in the December quarter. So a combination of these factors has led to a sharp increase in the net indirect taxes, which basically explains most of the upside that has come into GDP. And therefore, it's hard to assume that this sort of a trend can continue, and therefore I think we rely more on, at least for this quarter, more on the internals and the GVA numbers that have come, which are more closer or are a better measure of the underlying economic activity and momentum in the economy, and they were also in line with expectations.
So, Upasana, give us a breakdown of the numbers and what are your key takeaways from the latest reading?
So when we look at, say, the GVA measure, where we have agri, industry and services, this was largely in line with the expectations, our and consensus expectations at 6.5%. What we saw over here is that but this did slow from the previous quarter, which was above 7%, 7.6%. So the slowdown was driven mainly by agri and industry segments. So agriculture growth again sort of expected moderated further, and it declined YOY in the December quarter, reflecting some of the impact of the patchy monsoons on the crop production for the summer season. At the same time, the industry segments also slowed on a YOY basis, but to be sure, they still remain pretty robust. So manufacturing sector growth still remains double digit in real terms. Both electricity and construction activity is very high single digit levels of 9 to 9.5% in YOY real GDP terms. But these have all slowed from the September quarter levels. But this was again in line with expectations. This is what we could see from high frequency data points. points for the December quarter, and also from some of the profitability trends for the corporate sector as well. So again, not to read this data as a slowdown, but I would say as a normalization, because the base effect is also normalizing. The pass through of the benefit from lower input cost prices is also normalizing, and therefore when we look at the standalone numbers, I'd say GDP, GVA at 6.5%, or manufacturing growth, which is double digit, these remain still certainly very healthy. On the services side, there was improvement. Overall services GDP growth, GVA growth was at 7% versus 6% in the previous quarter, and it was driven by improvement in the trade, hotel services, and also by the financing, real estate segments, while by the public admin was largely steady. And when we look at the GDP internals, those that is by the consumption, capex, exports breakup, those were also in line. So consumption growth saw a moderate improvement. So private final consumption expenditure, which has been lackluster and sluggish, did see some improvement, but still remains at peak levels at 3.5% in the December quarter. That number was, almost a percentage point lower at about 2.5% in the previous quarter. Capex growth again moderated a bit, like you can infer that from the industry segment trends as well, or construction activity trends in the GPA bit as well. That also, but remains double digit again. So pretty robust, just a bit of moderation from the previous quarter. And net exports were a drag, but less of a drag versus previous quarter, as slowdown in imports was faster than the slowdown in exports. So overall, I would say this set of data that we got, and especially if we look at the internals, both from the GDP or a GVA side, were in line with expectations. It does show that the growth momentum still remains pretty decent, and there is a slowdown the BioI numbers are going to be lower if we look at the internals for some segment like manufacturing or capex versus the previous quarter. But I think that should not be read as a moderation or a slowdown, but more of a normalization, and standalone those growth rates are still very healthy.
So Upasana, are there any changes to your estimates for the full year in the light of the latest GDP readings?
See, the GDP data has seen revisions across previous quarters as well, as is usually the case when we get the GDP and the national accounts data set at this time of the year. So the base has also got revised. That has also contributed to some amount of upward revision across the 3 quarters of this current fiscal year. And therefore, we are going by the government's advanced estimate, the second advanced estimate for fiscal 24, that they've pegged GDP growth at 7.6, GVA at 6.9. So we are working with same numbers for the for fiscal 24. For fiscal 25, our GDP growth has been, we had rolled it out earlier in the year at 6.5%, and we continue to maintain that number. So no changes given this data set per se, and especially the internals was in line with expectations. We have not made any changes to fiscal 25 numbers.
So at this point, how does India's economy compare with some of the other emerging market economies?
See, India's economy has been doing pretty well, especially in a relative sense when we look at other EMs, TMs, etc. So I think that trend will continue. Of course, the GDP number in itself at 8.4%, and that's the number that gets quoted, and that's what you'll be, that's what you will get input into various other assumptions or projections as well. That has definitely takes India a further notch higher when you compare it on a relative basis to other EM growth or growth for EM economies. I think the key is also that this growth trend that India is seeing is more structural and virtuous in nature in our view. So this sort of good growth momentum or healthy expansion in the economy should sustain in the future as well. And therefore, I think India, especially on a relative basis, the economic growth should continue to outpace other EMs. And we think that India's contribution to global growth will also steadily increase. And by the end of the decade, it could could account for almost a 1/5 of the total global growth contribution. So I think the overall growth story remains very promising, given there has been so much that has been done in terms of structural policy reforms, and we are also seeing the benefits flow through if we look at capex or manufacturing numbers. And as the recovery gets further entrenched, I think we will see more broad-based growth recovery into fiscal 25, and growth rate sustaining at these 6+ or 6.5 type of levels for in the next few years.
So, what are the trends that you're picking in terms of urban and rural consumption?
Rural and urban consumption, I think that has been a topic of discussion for a long time in terms of the divergence or the slower pace of recovery in the rural segments or rural demand that we have seen till now. I think what we are seeing in terms of our rural activity tracker, when we look at high frequency rural data, like fertilizer sales, tractor sales, or rural unemployment rate, credit in the agriculture sector, or a host of such data points like two-wheeler sales, etc. as well. And rural activity continues to gradually improve in our view. When we also look at some of the data points such as volume growth by certain data aggregators for FMCG companies, then also it shows that rural volume growth for FMCG products is improving. It is lagging urban and it's growing off a low base, but it is still improving. So I think we are of the view that we will see a slow-paced improvement in the rural demand over the next year as well, and this should get further or the gap between urban and rural should narrow, because rural should get support from improvement in labor market conditions, which we can see with them pick up in capex, construction activity, real estate activity, which helps to absorb a lot of this surplus non-farm rural labor. And that also starts the process of that labor remitting money back from urban or semi-urban areas to rural areas, and that creates the cycle for consumption and growth in rural. On the other hand, urban, I think, continues to do fairly well. Most of the high frequency data, especially related to, say, services related data points, are doing fairly well, and that's what we can see in the data set, in the GDP data as well, that services sector has continued to recover further in the December quarter. But I think the gap between urban and rural should further close in fiscal 25.
Upasana, you made a reference there to capex, one of the factors that could help rural consumption. Now, private sector capex has been a little slow in picking up. What are the reasons for that, and do you see this trend changing anytime soon?
I think what we are seeing are early signs of some recovery in private capex. The reason I think for private capex that it hasn't become full-fledged and broad-based as of now is that I think we're still in the early stages of the expansion of the growth recovery cycle. So it's been like 2 years now that the economy has opened up fully after the pandemic. So March 22 was when the economy fully opened up, especially the services sector, mainly the services sector rather. And it's now 2 years into that recovery. And I think, it's a symptom of early stage expansion in our view, that, as we get more further into the expansion cycle, end demand will hold up further. And we're already seeing that in terms of capacity utilization rates, that they have been picking up and improving, though at a slow pace, but definitely the trend has been rising. And the momentum that public capex has created, that is benefiting some of the private sector investments as well, especially in the building material space like cement, steel. I think that will get more and more broad-based. We are seeing early signs of that when we look at CMI's data on private projects under implementation, on new private sector investments. On a per-quarter trailing basis, those numbers are doing much better than what the pre-pandemic trend was. So I think there are early signs of recovery. We will also like this to get more broad-based and more full-fledged. And I think fiscal 25 should be the year, because we will also be past the election event risk by then, and we will see more definite signs of a private and a more broad-based private capex recovery.
Upasana, what are the trends that you're picking up on the export side? You mentioned that net exports number did show some strength, but that was also due to imports slowing down at a faster pace. So, what are the broad trends that you're picking up there?
On the export side, when we look at exports of goods and services, I think exports of services continues to do fairly well. We did see some amount of slowdown on the exports of services and also the net export surplus that India runs on the services side in middle of last year. But since then, it has recovered and is now stabilizing. So the net services export surplus that India runs is sort of stabilized at about 5% of GDP. So that's been a good, or rather a very fantastic story for India post the pandemic, the way services exports and its market share has risen. So India's service export market share has also risen by close to 100 to 120 basis points versus pre-pandemic. That's also reflecting in the support we are getting in terms of dollar inflows and also on the growth side. When we look at exports of goods, of course, that's much more highly linked to the global growth cycle and the trends there. So global growth has done better than expected, but has still moderated versus where we were, say, 12 to 18 months back. And the same has got reflected in the trend in goods exports, especially on a YOY basis as well. Some amount of, when we look at the value levels for goods exports, some amount of the moderation is also due to the price effect, which is what gets reflected in, say, imports as well. Because imports, yes, as you mentioned, slowed down in the GDP data, but some of it is also because India is a large commodity importer. So, the decline in commodity prices just as a value also helps to lower the import bill. So on nominal terms, that is. On export of goods, we've seen that export of goods in terms of market share also has seen some improvement, but it has been much more slow paced. So it's probably 10 to 20 basis points higher versus where we were pre-pandemic. Some segments are doing fairly well, as we can see in the news flow related to the PLI sectors, especially on the mobile phone manufacturing or the electronic exports. But it isn't really a story right now that exports or non-oil exports are have recovered and are on a strong footing. So I think right now exports are more in a trend where they will stabilize, and then as the uncertainty on global growth dissipates, that's where at least the drag from lower export growth should get offset.
Upasana, we are seeing some early signs of trouble in the Japanese and the Eurozone economies. So does India have anything to worry on that front?
So those were also like for Japan, there was a factor was like it was a technical recession for them. India's growth is very domestic demand oriented, and therefore, at least as of now, the factors leading to lower growth in Eurozone or Japan's technical recession are not really going to impinge on India's growth cycle. We are working with our global team's assumption on global growth is sort of steady as of versus say 2022, 2023. So 2023 we expect global growth to close the year at close to 3%. We expect the number to be a tad lower, only probably 10-20 basis points in 2024. So I think as of now, with this information for either Eurozone or Japan does not pose any major risks. I think the key risks from global growth would be that if we were to see a hard landing or a recession in the US economy, which could create downside risks for India's growth, because that's not what we have in our base case.
Upasana, what is your take on the credit offtake? Now, if you look at it from the stock market lens, there's a lot of concerns that credit growth is moderating, besides the struggle that the banks are facing in raising cheap deposits. But particularly on the credit side of it, what are the signs that you're picking up there? Is there moderation, and what are the reasons for that?
So I think data till now is not really showing credit growth moderating. Credit growth remains pretty healthy at about 16% odd. But I think the issue is more about the credit deposit ratio, which has which is running between 77 or upwards of 77 also in some fortnights. And therefore the wedge between credit and deposit growth. So there is a persistent gap, though it has narrowed, but it still remains. So you have credit growth adjusted for the bank merger of HDFC close to 16%, and deposit growth, which is at about 12.5 to sometimes 13%. So I think the issue is more to do with the tighter liquidity, and also the outlook on deposit growth, and therefore the outlook on or therefore how this tight right now current tight state of liquidity, where how that impacts your credit growth in terms of outlook. So in our view, some amount of tightness in liquidity, especially the interbank liquidity that we are seeing right now, is due to frictional reasons. Some of it is being driven by government spending, which had remained a bit weak in December, and now we have the January data that was released yesterday as well. So government spending contracted. We know tax collections are pretty strong, so some amount of that government's cash balance is lying and is creating this frictional liquidity issues in the banking system. That should get addressed, because the government will eventually spend, and by March, and that's what we've seen in terms of seasonal patterns in previous years as well, that by March, the government cash balance with RBI tends to dip. So that is one factor. Second, usually liquidity remains tight in the last quarter, because generally a more a sequentially active quarter in India, so credit also remains stronger towards the end of the fiscal year. And then by April, sequentially, the seasonal factors tend to support interbank liquidity. So I think combination of improving seasonal factors as we enter into the April to June quarter, with this government spending issue, which has created frictional liquidity, that getting addressed will help to allay some of this tightness that we've seen, especially from December, Jan, and in part in Feb as well, though Feb has seen mixed days. Some days the interbank liquidity has been quite okay. So I think that has created more concern, especially amongst investors, in terms of the impact on credit growth, but we think that this will also normalize as we go into the first quarter of next financial year. We also think that from a more structural perspective, that as inflation moderates and real rates or real deposit rates increase, so assuming that nominal depository rates remain as is, that will also help to increase real deposit growth eventually. So that also, like from a slightly longer term horizon, also provides support to the overall credit growth outlook.
So Upasana, what is your outlook on interest rates? Now, is there a strong case for India not cutting interest rates before the US Federal Reserve does that?
So in our view, we are looking at RBI to focus more on the domestic growth and inflation trajectory in its reaction function. Given that RBI has managed the macro stability in a way that it has got fair amount of degrees of freedom. And the moderation in inflation will sort of provide them an opportunity to ease rates probably later in the year. So in terms of domestic growth inflation, we think that inflation will be the key metric given RBI's own inflation targeting framework. CPI inflation, which is currently at close to 5.2%, we expect that number to track similarly at 5 to 5.2 in the first half calendar year of this year, and then move to lower at about 4 to 4.5 in the second half, driven by also base effect related support in the YY trajectory. But nevertheless, we think that inflation trajectory is on a moderating path, and fiscal 25 for fiscal 25 we expect CPI inflation at close to 4.5%. So with 4.5% inflation, probably there will be an opportunity for RBI to ease rates. Our current view is that there will be a shallow rate easing cycle probably from June, and we build into rate cuts. Our view is for June is more in line or in sync with our US team's view for the first rate cut for US coming in June as well. So to your question on RBI doing any easing before the US Fed, in our base case, we are not assuming that. We think that they would probably be in sync rather than before the US Fed, given that I think even though India's external balance sheet metrics or inflation and macro stability are in good shape, I think there is a need to get comfort from the volatility that we have seen in terms of US Fed market pricing and movement in US real rates, especially in the recent months.
Yeah. One final question, Upasana. So, what is the outlook for the year ahead? You just mentioned your estimate, but what are the factors you think that could lead to the final reading being higher or lower than your estimate?
So, at the outset, I'll say we are constructive on India's growth outlook from fiscal 25 or a medium-term perspective as well. We think this cycle is more virtuous, and it has more legs to the recovery, in the coming years. What we've seen is that the recovery is being led right now by public capex and also say urban consumption, and we think this will get more broad based. We will see, as I mentioned earlier, the gap between rural and urban demand to narrow, private capex to also see more strength, further strength or recovery as we go into fiscal 25, which will get support from improvement in end demand, increase in capacity utilization, and also follow through of all the reform measures that the government has done and policy measures such as PLIs, etc., which will have an impact in the real economy as well. There's always a little bit of a lag between the policy measures and their impact as we feed into the real economies. So we think that for fiscal 25, as I mentioned, our growth rate as an expectation is at 6.5%, and we expect this number to be that the economy will be able to sustain beyond fiscal 25 as well. So from a medium term perspective as well, we think that say over this decade, the growth rate for India should average close to 6.5%, and this to be more of a capex led growth cycle, which ensures it remains virtuous, and we don't really see any major macro stability risks because it is a more productive growth cycle. So we expect this cycle to see capex to GDP also rise, and as per capita income increase, there will be implications for the consumption basket as well. So I think it's interesting times for India's economy. We will see probably more sustained growth expansion in the future, barring any exogenous, either domestic or external risks to this story.
Well, thank you, Upasana, for joining us on the show and sharing your insights with us.
Thank you.